show. Dr. Raghuram Rajan, India's Chief Economic Advisor, and a man who has answers to all my questions, like I say. Thanks very much for being with us. Before you begin to tell me today that I told you what I did yesterday, I want to ask you a question. It almost seemed like a Bernanke bombshell that the markets seem to have suffered from. There was disaster on the streets, the rupee crumbled, 150,000 crore wiped off in a single session. The government, however, still seems to be in denial. Will you refute me? Because the government seems to say the panic is unwarranted. But there is some truth to the panic, isn't there?
Well, if the panic was specific to us, if there's something you could tie it to, or something that we didn't do you could tie it to, then we'd be responsible. But this is a worldwide panic, which started sometime in May, once the Fed started saying we are going to withdraw from QE. It's something that I've been talking about as an economist outside, that we really don't know the consequences of QE. It's a huge amount of money, and when the withdrawal comes, it could be very abrupt. And that's what we're seeing.
Right.
So it's happened across the Asian economies, across the Latin American economies. So what did we do? If you look at rupee depreciation, it's on par with Brazil, Turkey, number of other countries. If you look at Sensex, the Sensex actually has depreciated far less than some of the other stock markets. So I can always pick something which has done worse, but in general, I think if you look at emerging markets, they've done badly over this period, which suggests that it's more than us. It's something broader. In fact, if you look over this time, the news within India in terms of what the government has done, the news about the monsoon, they typically have been, it's been good news rather than bad news.
I'm going to come to the good news because they always say wipe out the bad first. You're right when you say that this is imminent. The Fed will have to withdraw the QE stimulus, but the fact also is that he's given a timeline finally. Ben Bernanke is saying it will, if all is well, it will begin to taper off from the end of this year. Could India have been better prepared? I buy your point that it is a worldwide phenomena, but what we saw with our currency, for instance, it has been Asia's worst performing currency. I'm going to come to the rupee in just a bit, but do you think we could have been a little better prepared?
Because I think worst performing depends on from where you take it. And remember, from the beginning of the year, we got inflows. So then if you take it from, 1st May or whatever, we appreciated. Before that, before we depreciated. Right. You look at, for example, since last June, we're on par with almost anybody. So I would not push that worst performing too far. But I think the real issue here is, what would you have us do to prepare for a large scale across the emerging markets outflow of capital? Unless you prevent that capital from coming in by saying we don't want any flighty capital, and you have to tell me how to identify that. How do I identify flighty capital? But we can't afford
doing that given a huge CAD level.
Absolutely. So you have to tell me, and I'm asking you to respond to the question you asked me. How do I prepare better for it? In some sense, when you take in money, you cannot tell the flighty capital from more stable capital. We're trying to do more of that. We're trying to do more of that. Recently what we did was we opened the doors wider for pension funds and sovereign wealth funds, which tend to be more stable. Of course, as you know, we've been trying to get FDI in a bigger way. It takes time. In the meantime, we have to finance a large current account deficit. And the current account deficit is not created by the government in some sense.
True, yes. Do you then agree, and you're making a candid admission here, that we do run the risk of flighty capital, we do run the risk of capital flying overnight?
No, what I'm saying is that with any capital coming in, there's always a certain element of flighty capital. What you need to do is make sure that overall, that your proportion of more stable capital is significant enough for you to be able to withstand these outflows, right? And so what you see is, despite our large financing needs, again going back to, we haven't done much worse than anybody else. We're on par with a number of other countries. So what we need to do going forward, and this is why we need to focus on shrinking the current account deficit. The good news there is gold imports have come up quite substantially. But also, I think over time we have to increase our exports, reduce the unnecessary imports that we have, unnecessary in the sense that we're importing because, our mines are shut down, unnecessary because we're not able to produce certain kinds of things. So we need to do that.
Those are sane measures, and like I said, you will perhaps talk about return of sanity. Those are sane measures, I agree with you, but these are, again, long-term. You cannot increase FDI caps across sectors overnight.
We can increase the caps overnight, we may not get the money overnight.
All right. You cannot increase your exports overnight. These are mid to long-term measures. What can the government do short-term to avoid any overnight flight of capital?
Well, so really what you want to do is convince investors that it's valuable to stay for the long term or the medium term. And that's why it's important to have these measures, not because overnight they're going to bring in capital, but they're going to tell you that India is a much better place to invest in than some of the alternatives that they have. And that is really what we need to do, to show that despite all the gloom and doom in India, and this is what I keep saying, India is whiz-wig. What you see is what you get in India. Everything's out there. All our dirty linen is out there for everybody to see. And so to that extent, we get overly pessimistic because our dirty linen is hanging out there. We don't see other people's dirty linen. We say it's so terrible with 5% growth. Brazil has 1.5% growth and riots in the streets. In comparison, remember, they're also a BRIC.
Is it then a question of whose linen is dirtier in public?
Today in the world, that's the problem. And so everybody has slowed down relative to their past.
Right.
We in India look at that and say, oh, we slowed down from 9%, how terrible. But we're at 5. Brazil slowed from 7, they're at 1.5. So, it's all relative. And so, yes, we have problems. We are trying to fix them, but let's have a sense of proportion.
You started this answer by saying that we have to convince the investors to stay invested here. This is a better place to be in than any place else. But when you actually see at economic realities, when you do see a US economy recovering, obviously the QE will be tapered off. It is a market that investors want to be in. Will it be easy to convince them?
No, the environment is getting a little harder as interest rates move up. And by the way, interest rates, the Fed has said, we're going to stay for a long time. We'll taper first, then we'll start moving interest rates way down the line. But I think the point is, yes, it has become a little harder to convince people because, rates there will move up enough for people to keep the money at home. Search for yield will become less pronounced. That is not to say that it will not still be there. Ultimately, people are looking for growth. Growth in equities, growth in infrastructure, growth. They're going to want to invest. And they're going to invest in areas where there is a hope that credit risk improves, so that bond yields come down, that returns on equity increase. Now, where can you find that kind of growth? To my mind, India is, a no-brainer because there's lots of low-hanging fruit. Our mistakes of the past are,
and there have been many.
There have been many. But rectifying them is fairly easy because we know what the mistakes are and they're pretty obvious.
Do you then, in your assessment, believe that till this time we have been very reactive? We have reacted to what has happened across the globe. We reacted to gold imports going up. We brought duties up. Have we as a government been reactive, and should we have been more aggressively proactive, if that's a term to use?
I wouldn't say that. I would say that we recognized earlier on that we needed to stabilize the economy. The first thing that Mr. Chidambaram did when he came in as finance minister was laid out the medium-term fiscal plan. If you don't have your fiscal deficit under control, there's no question of stabilization.
That's right.
The fact is, people trust Indian government bonds now because they think that Indian finances are relatively under control compared to some of...
There's prudence there.
Yeah, there's prudence. Look at our government debt, 40% to GDP at this point for the federal government. So, for the central government. So, in that sense, finances under control was the first thing. If your finances aren't under control, you have a deep problem.
That you can do.
So, that's part of the strategy. Second part of the strategy is, yes, our current account deficit is blowing out, therefore make sure the financing is available. For 2 years we financed a fairly large current account deficit without dipping into reserves. So opening up to flows of various kinds, FDI most of all, FI to the extent necessary, and of course ECBs to the extent that fills the rest of the gap. So that was also part of the strategy. Gold, to some extent, the tremendous increase in gold over the last few years. The last part, the April, May, I would agree, took me by surprise. I remember Mr. Chidambaram saying, look, gold imports are going to go up. People are happy that prices have come down. No. And I said, no, I think imports are going to come down. And it turned out that he was right on that. But this, we didn't anticipate, at least I didn't anticipate the substantial increase, but we've taken some measures since then. So if you could say reactive, well, it was not so much that we didn't see gold increasing, we've been doing things for that, but this last bit was perhaps a little
I'll tell you why I asked that question, because yesterday when you addressed the media with what was happening, you said you have a lot of instruments to arrest the volatility. One would like to know what those instruments are. And the obvious question that some of us would want to ask is, I know you don't want to discuss it on national television, but one would want to ask you this question that when rupee reaches 59.90 to $1, what is the RBI waiting for? It did finally intervene, it did not reach 60, but do you not believe this is the time to be more aggressive? This is the time to come out with measures that nobody has really thought about.
But you have to understand that when you have a wall of capital either coming in or flowing out, that sometimes is very costly standing in the way. You'd rather wait till your actions have the most impact, right? So I'm not talking about, with knowledge, I'm not expressing what the RBI would do, but talking generally about what a central bank would do. It would wait till the moment of maximum advantage and then use all the firepower that it has to, push back, right? If it wants to do. You don't sort of push back when the mass of money is moving against you, because then it's you waste a lot of money trying to fight it, right? Why would you want, for example, if people want to leave, why would you want them to leave at 57 when they can leave at 59? Isn't it cheaper for you that they leave at 59 than they leave at 57? Now, clearly, you don't want the exchange rate to stay at a disequilibrium level.
Right.
So you have to have a sense yourself that what is it that you're uncomfortable with?
What is the maximum advantage position according to you?
I don't know, it depends. You want to look at the details of the market. You have to know who the market players are, who's moving against you, what kind of money they move. I mean, this is far more detailed.
Sure.
And involves a lot more knowledge than saying, oh, the rupee is falling, let me fight it.